Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 70. As always, joined by the three amigos. We got Rich Diaz of Acorn Macro Consulting over in the UK, and we've got Keith Dicker of IceCap Asset Management with a Patagucci, another new Patagucci jacket. It must be a bull market there.
Yeah, I have a wardrobe. I have remember that show, the movie The Fly? Remember that? With Jeff Goldblum. I don't remember
before my time.
It was more than 5 years ago. Anyway, he had a really cool wardrobe. He opened up his closet and he had like 20 of the same shirts and 20 of the same trousers and stuff. That's me. I have a lot of the same clothing.
Your Patagucci, man. Yes. Times are good.
Patagucci. Yeah, sure thing. Rich. What's going on over there, man?
I got some more flowers. It's tulip season.
Just for the show.
Just for the show. I got some more flowers over my
you read the
right
sign
shoulder.
on it, the sign says, "To Rich from Rich."
Yeah, that's right.
This show, it's turning into more of a dating show. There's been a lot of comments. They're very interested in what's happening in your extracurricular.
It's not working or helping in any way. So I would
the pressure is really mounting.
The pressure is mounting. Still brokenhearted, but at least days are getting longer here in the UK. The weather is spectacular. Went on a nice bike ride this afternoon. And I'm ready to talk about macro markets. Lots of good stuff going on. Lots of shitty stuff, lots of funny stuff. So let's Steve, take it away.
Yeah, we got some big news. I leaked what I could a day or two early there, but kind of some guys I've been following for a little while. You kind of tend to know who the players are and who's, when the tide goes out. So it was a big Vancouver developer. It's now out in the public news there. So they had over $1 billion in land holdings in Vancouver, something like 20 plus sites. They just filed for creditor protection, bankruptcy, essentially. And so it's obviously making the rounds. It's huge. I don't know if I'd say it's shocking for those that are like deep entrenched in the industry. But it is big news. Basically, it was a offshore, Chinese developer that was basically here land banking, overpaying for sites, refinancing every several years, taking out very, very expensive debt. They didn't even care. The conversations I've been having is, they cared less about the interest rate on the debt, and more about what kind of loan to value can you get. Basically taking that cash, redeploying it, and just going on a mad buying spree, which I think really highlights the sentiment or the mood in Vancouver and, Toronto for that matter over the last 5, 6, 7 years, right? Which is
30 years.
Right. But in particular, the last 5 to 10 years, it's been supercharged, right? I mean, starting in 2015 with the massive flight of foreign capital out of China. And since then, it's just been supercharged. And so really, I mean, the notion has been like, there's no price too high that you can pay. And every year land values go up, 10+%. And so that kind of makes any purchase look good over time, right? And so that's pretty much what these guys did, is they just kept acquiring. And now, of course, right, like interest rates all of a sudden surge higher. It's getting more challenging to get money out of China, number one. And number two is obviously land values are starting to come off and the market conditions have changed, and people are like, I don't want to refinance you anymore.
Steve, do you think this is just like the first of many? So I have a couple kids who work for me. They're great. And I always teach them, when you see a mistake in an Excel spreadsheet, or if you hear of some fraud, or a certain politician has done something unethical, there's never just one cockroach. you know? And my question to you is this, do you think this is like the first of many? Do you think that there are loads of them we just haven't sort of heard about, or that haven't been made as public, or perhaps aren't as big? But is there only one cockroach, or?
I mean, there's always more than one, right? I mean, I think that I've got a couple on my list that I've got circled on the bulletin board, but we'll see. I suspect, some names will pop up. I don't know, maybe later this year, but yeah, there's gonna be some collateral damage. I think the big thing here is like, it's just a reminder to a lot of these like lenders, because this company wasn't going through like traditional tier one banks, right? They're going through mortgage investment corps predominantly, so private money basically. And so I think it's just a subtle reminder to them that, hey, listen, like these guys just blew up. And so I think they're just going to get more. I think money's just going to get tighter. It's going to get more conservative. And so that's just going to make life more challenging for some of these more fringe or less capitalized developers.
I have a question for you. I find this interesting as well. And I'm not quite sure yet if this is an isolated event or if it's widespread. So how much capital is exposed here? Like how much did they raise?
It's over 700 million.
So of that 700, so much is it all borrowing? So individuals investing in these, private label GICs that are sold with no
I mean,
stuff.
Yeah, I think don't quote me on this. I think predominantly like a lot of the companies that were issuing debt to them is a lot of it is like, yeah, wealthy money, private money. Sometimes it's sort of like family offices and stuff like that. Yeah,
I think in my world, like on my desk, sometimes we'll bump into people, and they bought one of these GICs with these private borrowers, basically what it is, because they're lending, and obviously their yield is a lot higher than if they had it elsewhere, like on a bank's balance sheet or something. And you have the conversation, hey, is there a risk with this? And of course, a risk is only a risk if it happens. If it doesn't happen, people don't think it exists. But as you said, like there are people out there right now that are going to be hurt with this. Somebody was expecting to have a GIC or an allocation to this mature imminently, and now I'm assuming everything is now tied up for a while.
Yeah,
and
it's going to go
on the dollar and stuff.
Yeah, it'll go through litigation and everything. I mean, to invest in like a MEC, individually, especially ones that's going to lend to a developer, like you have to be a high net worth accredited individual, right? So there is some hurdles. It's not like the average retail guy, some blue collar workers just throwing a little bit of chips into these funds. It's like, no, you got to be accredited to get in there. So yeah, I mean, I think that
but I think the regulation is pretty lax with it though, isn't it?
It is pretty lax. It's not very regimented, but I think in general it's typically, higher income earner professionals and stuff like that, could be doctors, dentists, lawyers of that nature, right? Realtors,
economic strategists.
Realtors love doubling down on the realtors love getting high on their own supply. I'm not going to lie. They, if they get their hands on a couple pre-sales and a couple mix and just keep it all churning on the same trade, that's what they love to do.
I remember back when the tech bubble was bubbling, and so Rich, that was back in the late 90s. By the way, that's
before the internet.
It was literally pre-internet if you think about it. But I remember chatting with people back then, like, what are they? I remember one guy said, oh, I only buy tech stocks. I said, well, why? He said, well, that's the world I'm in. That's what I know. I'm only going to invest in stuff that I know. And it turns out in the end, they didn't know. So, diversification helps. Steve, are there, again, I don't know the story well enough, but are there actual developments on these pieces of land, these properties? Has someone like bought a pre-construction unit and now all of a sudden they're held up in court and everything as well? Is that happening?
Yeah, there's most of them are undeveloped because, like I said, I think I would call them predominantly land bankers. The idea basically is like, okay, like in Vancouver and development, especially, like you have to have just gobs and gobs of money. And most of the time, like honestly, the profit margins, people think developers make tons of money. The margins are razor thin. The risk is astronomical. And so, the idea really is like, okay, you're competing with so for example, you're competing with this company, and they basically they don't even care so much about the valuation. They're just like, they just want to acquire, sit on it, let the market do its thing, which is go up and to the right. And so they'll overpay for a parcel of land, and then they're just like, yeah, we'll sit on it for 8 to 10 years until the numbers make sense, and then we'll build it. So like the holding
with
power
100% with 100% financing, basically, right? At that point?
I mean, they're trying to get as close to it as possible, right?
Yeah,
so,
okay.
And so long as the values continue to go up each year, right, they can kind of just like refinance they can basically refi to pay down the other debt, essentially like a Ponzi, right? So, that's essentially what was happening. So they did have one project, I think, that's under construction right now. Actually drove by it the other day. So anyone that's bought pre-sale in there, they will get, they should get their deposits back. It is pretty regulated, the pre-sale market here. So trust deposits get held at a lawyer's office. And so those will get released back.
Right next to the booze table, right?
Yeah, that's right. So
I have
anyways,
a lot of lawyer friends.
Long story short, I think what's happening here is interesting. I think that there's some rumblings that, again, it's getting a little bit more challenging to get capital out of China. I think there's a bunch of really large luxury projects, pre-sale construction in Vancouver, and I know in Toronto as well. Some of these numbers, $2,600, $3,000 a square foot that are coming for completion later this year. Are people going to be able to close on them? Because can they get their money out of various countries to come close on them? Can they pass mortgage stress tests? I think that's going to be really interesting, because at $3,000 a square foot, what are these things actually appraising at today? I can tell you they should be appraising a lot lower than what they were pre-sold for 5 years ago. So that's going to be interesting. That's
cool.
One more question on this. In the sort of the chain of events, when was the last time this group acquired land or a property?
I don't have it off the top of my head.
Yeah,
but recently, in the last couple of years.
Well, then I have a question that you might have the answer to, which is this the first one of its kind in this cycle?
Yeah, I think it's like the notoriety.
Yeah, size, scope, and publicity.
Size, scope. Like, of course, there's always these small little guys. I've got a small townhouse site in the suburbs. Like, nobody really cares. But these are like large inner city sites, prime real estate, very, very expensive. And
it's the first one of its kind.
The first one of its kind in this cycle. So, like I said, I think we'll see more of them later this year. I don't think it's widespread, but I do worry that we're going to continue to see, with these interest rates, people that aren't going to be able to close. So I'll give you an example. I was chatting with my bank, RBC, the other day, and I just said, hypothetically, I'm always have my eye in the market, and I'm always like this. I have a bit of the wandering eye, because when you're in real estate and you see deals all the time, you're like, well, maybe I should buy that. And so, you kind of want to buy everything, right? But anyways, long story short, I'm not buying anything, but I was just inquiring. So I talked to my lender, said, hypothetically, if I wanted to buy this, can you run a pre-approval for me? So she runs this pre-approval, and she comes back to me and she says, well, you only qualify for this much. And okay, that's interesting. That's fairly low. And she goes, because I have to stress test you at 9.2%. Stress tested at 9.2%. I was, well, your variable rate's about 6.5%. So I was kind of asking her a few questions. Is because they were qualifying me based off of RBC's home line plan, which is basically like their line of credit plan. It's essentially a variable rate mortgage, but it has to be stress tested as if it's a credit line. So that brought the rate to about 7.2%. Add on the 2% from OSFI's stress test. So you're getting stress tested at 9.2%.
So no one can finance anything, basically.
It's just like the borrowing power just has been crunched. And so that's why I still think, like, I know like a lot of the industry is getting all hyped up because January's been filled with a bunch of multiple offers and busy open houses. I'm still struggling to say this is going to be a sustained rally given the level of stress tests. Interest rates are still really high, and borrowing power has been crunched by about 30%. So
that's interesting because that reconciles with our view. We've been talking for a while, and it hasn't happened yet. But if we do get a recession here in Canada, and it's not shallow, it's not one of these soft landings they're dreaming of. All of a sudden, you're not going to be tested at 9. It's going to be 12%, 14%.
You think that's how it's going to work? If there's a recession, they're going to cut rates, and then they're going to say, "Oh, you're going to stress test at 1% or 2%." No, you don't think that they'll?
Thanks. They will adjust their models, and if all of a sudden they're anticipating the economy to get weaker, then they're going to demand, like, they'll self-impose their own credit spread. That's what they're going to do.
Okay,
Yeah.
fair enough.
Like, why would I lend to Steve at 9%? Not Steve, of course, but somebody else at 9%.
Yeah, gotcha.
And all of a sudden, I'm thinking, man, they might be out of a job. Like, right now, they can fund 9%, but that may not happen in 3 months because of job losses and stuff like that.
Well, we had Ron Butler on the show last week, right? And he said the bank's biggest concern, right? I mean, naturally, was employment, right? I mean, that's always the concern. I mean, people are sort of getting by. There's definitely people struggling, but people are getting by and scraping together what they can to sort of pay off these higher rates. But if you lose your job, obviously that's almost impossible.
Well, that's the big one, right? Because if you don't lose your job, you
make it work.
You're going to make it work. You know what? Like, you're only going to go to Tahoe twice in one season as opposed to 3 times. And
Taco Tuesdays.
You want to go to St.
Tahoe,
Anton.
not taco.
Oh, yeah. Rich won't be jet setting all around the world and everything. But that's the key thing here, right? It's employment, which, by the way, in Canada, this is Thursday, right? So tomorrow's Friday. We have the Canadian jobs data is going to come out.
Ooh, random number generator. Let's go.
I know.
Well, it was revised down. So we should let people know that, because I think last month it was 100,000, 104, and it got revised down to 69,000, I think.
That's right. Yeah, people were.
That was shocking, wasn't it? Remember, we were like, "What the heck? Like, that makes no sense." And of course, they got revised down. The estimate tomorrow is 15,000. So we'll see what happens. So that means the number will be anywhere from 150,000 gain or loss, something like that.
You know what they should do for the jobs numbers? They should get Maggie the monkey from TSN to spin the wheel. Does anyone remember that?
Yeah, I remember that.
Keith, you remember that? Maggie the monkey, TSN.
No, I don't know.
Keith doesn't pay attention to hockey.
Yeah, in the playoffs, TSN always used to have all the good coverage back in the day, and so for every playoff series, they would have Maggie the monkey spin the wheel to predict who was going to win the playoff series between each team. And I think her track record actually ended up beating all the TSN analysts on the show. So
this is after Original Six, because that's what I used to watch.
Oh, Jesus. That was like
okay.
1980s. Okay. Oh boy. Yes, it was after expansion.
Yeah.
Anyways,
yeah.
so the job numbers are coming out tomorrow.
Well, we should talk about the U.S. job number, because that was a blowout.
I'm not done with Canada here.
Okay, sorry.
Whoa. Give Steve some space, guys. He's just getting lined up.
Getting started here. No, I just sort of wrap this whole sort of thing up, right? So I guess 2 thoughts. One was we also had the BOC's Macklem. Tiff Macklem was out in an interview, I guess, 2 days ago, essentially coming out and saying, high household debt levels were one of the reasons for ultimately pausing their interest rate cycle here. Which I mean, realistically, let's be honest, this shouldn't be surprising to anybody. But
it's a bit of a joke. I mean, given what has happened over the last 10 years or whatever. But anyway, keep going.
Well, I mean, it is what it is. It's an unsustainable.
Yeah, debt to GDP is up at 100, and go on.
Yeah, it's unsustainable debt Ponzi that essentially, very difficult to actually normalize interest rate policy. I'm surprised we've gotten this far without anything blowing up yet, except for Coromandel. Rest in peace. But that's where it is. And so we're going to see now this, the supposed rally that's happening in the housing market right now. We'll see if that's sustained because, if I'm the Bank of Canada, the one thing I'm flagging, which is what the Fed's Neil Kashkari, who I actually despise, but he was out as saying the housing market in the U.S. is starting to show signs of life again, making our jobs harder, which, Keith, I'm curious your thoughts, but ultimately my opinion is, if we actually did have a bounce, let's say, in housing, what motive is there for central banks to even contemplate cutting rates, which is what everybody's banking on in 2023?
Yeah, I mean, if we don't get a recession, the banks ain't cutting rates. I mean, that's not going to happen. So, I mean, the only way you would cut rates is this. I know they need to provide more stimulus again, and right now it's right now that the central banks, including the Bank of Canada and the Federal Reserve and those guys, they're now launched into this mode that, okay, we're starting to see, actually the Bank of Canada communication this week, they actually referred to green shoots. Do you guys remember the green shoots comment?
Yeah, that's from 2008, 9, 10, right?
Yeah.
There's green shoots, and everybody was looking everywhere for the green shoots.
They're Bernanke, he said, yeah, we're starting to see green shoots, recovery's coming. Everyone's thinking, what the heck, and even these days, I'm walking around, I'll see a little bit of green pop up, and I'm like, a green shoot, so that's how you're cool, when you remember central bank quotes from over a decade ago.
My coolness has been well established.
Yeah. Yeah, that's your pickup line. I see green shoots. There must be a drink called green shoots or something.
Well, we can make one.
Did you want to get it, Keith? Did you want to get into we also had Powell out this week, he did an interview with was it Rubenstein?
Yeah, it's a couple things. Actually met Dave Rubenstein back in 06, 07.
You guys are like the same age, aren't you?
I think so. He's been a bit more successful than I have. But he's, people that don't know, he's one of the founders of Carlyle Group, which is one of the swamp creatures in the swamp, if you want to get it that way. But they're a private equity firm. They have offices all over the world and everything, but to let you appreciate how the world works, their main head office is in Washington, D.C., right? Not New York, not London.
Not Bahamas or Bermuda.
Yeah, like none of the four corners of the world. It's in Washington, D.C. Anyway, so you need to know that's the way the world works. But at the economic, I think it's called the Washington Economic Club or National Economic Club, to become a member, you need to be part of the swamp. Anyway, so Rubenstein, he interviewed Powell yesterday. I think it was yesterday or the day before. And it's actually a real nice change up from normal speeches that Powell will give. So Rubenstein, he's actually really good at interviewing, asking questions, and he didn't hold back. Like, he was going straight at Powell with stuff in a nice, kind way. So that happened, and it's funny because with Powell, if you read what he says without listening to it, you'd say, oh wow, yeah, he's actually hawkish here. That's what he's saying. However, if you listen to how he's saying it or the tone with it, you think, oh, he's not. It's kind of lovey-dovey. So maybe, Rich, when you're hearing what you think are rejections, maybe they're not rejections. You're just not. Maybe you should be reading it. Boy. You'll get a different sign. But that's what happened with Powell this week. If anyone has a chance to go back and watch it, it's really interesting to hear him talk and everything. And it made him a bit uncomfortable in a few situations. He confirmed what his salary is for the year. I think Steve knows what it is.
Yeah, $190,000 a year.
Yeah, but that's well known. Why is that a surprise? I've known that.
I don't know. I
since
thought that
a
was
kid.
interesting. I don't think that's even remotely close to enough. And they asked him if he thought it was.
He's a government employee, effectively.
They're like, do you think you're compensated appropriately? And he's like, yes, I do.
You know
Well,
why?
two
Because
things.
as soon as he's done doing his Federal Reserve duties, he's going to go on a speaking tour like Janet Yellen and get paid $250,000 an hour.
That's true. That's true.
Yeah.
190 grand though. I mean, Rich, that's totally true. I think 190 grand though to do that job is
it's with the promise that you get a full pension plus anytime you ever
that is
open
the
your mouth
worst
ever
job,
again.
though.
Someone
I
gives
can't
you
think of a worse
$100,000.
job.
Oh,
Now,
I
mind
don't know.
you, Rich, Steve is, Steve and as a realtor, he doesn't get out of bed for like 200K, right? So 190 is a downstream number. But Rich is right though. All these guys, it's for the payoff afterwards. I mean, like Bill Clinton was famous. They came out of the White House bankrupt, basically. And somehow, the Clinton, what was their foundation called? The Clinton Global Initiative. That's what it was. All of a sudden, they raised like $5 billion. That's crazy how they did that.
Drain the swamp.
But
Yeah,
back to
that's the
your. But
swamp.
can you just round out your points on Powell's what he said, sort of versus sort of his tone? Because I think that's really important.
Yeah, so it's a couple of things. Thanks for bringing this back in, because this was going nowhere fast. So a couple of things, a couple of comments. One that you pointed out a couple of weeks ago, Rich, like services remains very strong on a national basis. It's just the demand for goods is starting to come down. So we see companies out there warning, they got to sell off inventories. It's on the good side, but services is still strong. You see help wanted signs, at the servicing sector, it's up there. So he acknowledges that. But he also kept saying that, hey, this process is going to take time. And he did not hint that, hey, we're finished hiking rates. He said we could keep going. We're going to, continue to monitor this. So again, like he says all the right words, but he doesn't say it with, any energy and enthusiasm. He should be like hitting certain points right on or anything. So maybe they need training with that. So markets after that, like initially they're selling off, which what they should have, and then like zing, they did a 180. And now here we are 2 days later, and markets have done a full round trip. They're back to where they started again. So it's interesting right now, like with equity markets this year, especially NASDAQ, like it's taken off. And, people are saying, oh, wow, here we are back again. Things are going. And the S&P and the Dow, the rally has been very muted relative to the tech sector. And some people are positing it's just the bear market rally, and maybe it is right now, but the net shorts have now evaporated, so they've covered right now. Equity markets, that is, they're kind of neutral, so people haven't completely piled in yet, so the rally can have some legs, but earnings are starting to roll off. What do you see on earnings, Rich? I know you had some.
So it's earnings season. It's earnings season. So obviously I usually look at the S&P 500. There's 501 companies in the S&P 500. And I think there's 460 in the Euro, 560 in the Euro stocks or something like that. So don't get too hung up on that. But 66% of the companies have reported. Of those 66%, most of them have beat. Now you say, well, that sounds good, doesn't it? So most of them have beat. What does that mean? You have beats, you have misses and beats. So analyst expectations will say a company, Apple needs to earn, X amount, $100 a share. And they'll say, oh, they beat by $101, right? So, by towards the end, towards the release, the analysts get pretty close. But there's two things that are really important to note from that. One is that the beats are actually quite low relative to history. So analysts will make expectations on earnings and then sales, and both earnings and sales have beat, but a lower percentage than the 5-year average or the 10-year average. So that's important to note. And then the other thing is to note is that earnings expectations themselves have come down significantly. So they're beating less frequently, and the hurdle is much, much, much lower. The other thing that I thought was really interesting is the FactSet, which is like a really big, basically information aggregator for public companies. It has posited that will have the first negative earnings growth quarter, I believe, since the pandemic, obviously, because when everything got shut down, but so that's really interesting. I have sort of models that also suggest that that's going to happen too. But the market's actually been quite muted. So what we often do is we look at sort of the announcement and then specifically the reaction. What happens towards a reaction. So if you announce that you miss, will you get a huge sell-off? If you announce that you beat, will you get a price rise? And actually, on a lot of the misses were sort of met with rising stock prices. And so people would say, well, maybe a lot of this information is already in the price, and the earnings expectations have been sort of well calibrated. We'll see. My focus has been on margins for a long time. I don't know, Keith, is that a fair summary?
Yeah, I think you hit it right on. I mean, from top down, guys like us are saying we should see a slowdown. And now we're seeing companies for the previous period, they're making less money than what was originally expected. Remember our conversation about the squiggles? Remember we did that there a few
we showed that
podcasts ago? Yeah, we won't go back and revisit it, but earnings estimates are always higher at the beginning of the year than what they actually are at the end of the year. But now we're starting to see some companies warn and struggle. And speaking of companies that are struggling a little bit, we have Credit Suisse and SocGen. So Credit Suisse, that's the one of the Swiss investment banks, and SocGen is smack dab in the middle of the economic fantasy land called Europe. So the reason those guys are in the news these days, Credit Suisse, they're bleeding. These guys are bleeding clients and capital every minute here. And then so them together with SocGen, they both basically have to pull back or roll back on bonuses that were promised to employees and staff. So it's like all hands on deck, people are leaving. And the way it is in the banking world, the invested capital really is intellectual in relationship building. Like there's no copyright
widgets
or patent. Yeah, like they're not making stuff, right? It's just people with spreadsheets and who that's why it's very important. Like Spencer Strathmore, like he knows a lot of people, so he brought a lot of people into Anderson Financial. You don't know what I'm talking about, do you?
No idea what you're talking about.
If you know. Anyway, but there's an expression, hell hath no fury like a pissed off banker. So I think that's what's happening today over in Europe. There's a lot of guys leaving. But one more thing though, when bankers are leaving one side, they got to go somewhere else. So there's other banks out there now, arms wide open, say, yeah, come on guys, come in with your Rolodex and stuff like that.
They're getting their
You
real
quoted from Ballers. I never watched that show.
Keith, do you feel there's any contagion building or potentially building from Credit Suisse? It's kind of been talked about for the last year now. Like everyone's kind of been well aware of their issues, but it seems to be a bit of a slow bleed over there.
I think that's more firm specific right now. So until it does seep elsewhere, you just have to take it as a one-off event.
Okay.
The thing is, so the only thing I would just say is that the market cap of Swiss banks is very, very small relative to global banks. So that's the only thing I would say. I think it's, I can't remember. I had the chart in my old chart pack and I can't find it now, but as a percentage of market cap, it's very, very small. Although the CDS spread, so the credit default swap, is still quite high. I think it's at 250. Just to give you an idea, UBS, which is another Swiss bank, is at 55. So you can roughly say, it's 5 times the default risk. I know that's not quite right, but just for argument's sake. But in general, the entire Swiss banking market cap is actually quite small, right? So you've got a much, much bigger market cap in the US and then Japan and then Europe, etc. So even if that were to totally blow up, unless they had some shenanigans with derivatives or whatever it is, I don't think it would make that big of a mess. But maybe that's famous last words.
Or infamous last words. Speaking of which, I mean, it's not in the same lines at all. It's just on the whole banking sector. coming up now in a few weeks, the beginning of March, I think it's March 1 or 2, the Canadian banks will report their earnings. So as you know, we've been on this terrain now for the last 3 quarters, is to watch their provision for credit losses. That's what you need to look at for the banks. Remember, about 3 quarters ago, RBC did that famous boomerang. One quarter they had a negative clawback on provisioning, which helped them beat earnings estimates, and then the next quarter they had to double up again because they, something really wrong went down at RBC for them to do that. But we're going to get more perspective on what they see coming forward, and with Canadian bank loan loss provisioning, you want to call it, what they call it different things these days. The absolute dollar is very similar to what they've been carrying on the books over the last decade. And that's significant because we haven't had a recession over the last decade. It's been pretty good. But the amount of lending today is greater than what it's been over the last decade. So if, again, we keep going back to that, if we do experience this recession here in Canada, I think you're going to see banks, they're going to batten down the hatches very quickly and aggressively. And then that's going to cause Steve not to be able to borrow as much as he wanted to 30 minutes ago.
I'm tapped out. I can't do the 9% stress test. I'm over it.
Bank of Canada, guys, they had a big announcement this week. 2 announcements this week. Did you see them?
No.
We chatted about one of them, which was he's pausing because of the housing market, basically. What's the other one?
Yeah. So 2 things. First of all, they added an outsider to their inner circle. So they
Is it you?
No, I'm an insider, guys. Come on. I'm an insider. Give me some credit here. No, so the Bank of Canada did 2 things, and they're both moves to help reduce the critique from 3 guys with a shovel on a podcast, basically. So first of all, what they've done, they've hired an outsider to be on their decision-making board. I don't know what they're called, but his name is Nicholas Vincent. He's based out of Montreal. He just has an outstanding background. This guy is incredibly sharp, but he's going to bring a different voice and perspective to help them with decision making. So we'll see that now going forward. And the other thing they did, the critique with the Bank of Canada, we've said it quite a bit on this podcast, is that they lack transparency all the time and consistency. Remember, I'd always say, I have no clue what they're going to do. They should do this, but let's just wait and see. Whereas the Federal Reserve, they've been pretty transparent, the same with the ECB and everything. So for the first time ever, they came out with a publication called the Summary of Deliberations. And
can I ask a quick question? Is that the same thing as the minutes for the Federal Reserve?
Yeah, I think you're right, Rich.
I read through it, Keith. There was nothing of substance in there.
No, but the minutes are never of substance either. That's why it was sort of my question, right?
Yeah,
so
but before it's a black box. So like I'm
right.
sort of, I'm not defending them. I'm just sharing, you know what? They've taken the first step, right? And probably the biggest thing that came out from this document or publication, not only were they considering pausing, the whole debate was whether 25 or nothing. It wasn't like 25 and another 25 or continue being hawkish. Like they were clearly at the point where they said, okay, we need to stop what we're doing, because they believe they've now reached the point where, very bad things may happen. They didn't use those words. They used, Bank of Canada-ish like language with it. But that's where we are. That was a big event, guys, for the Bank of Canada this week. Congratulations. Yeah. We know you're listening and watching.
Of course, Rich, you can read all about that in the Globe and Mail. In fact, after your derogatory comments, the Globe and Mail reached out to us.
I've subscribed.
Well, they're offering you a 3-month subscription pro bono to give it a trial run. Our latest and upcoming sponsor at the Globe and Mail.
Yeah, well, that's even better deal actually. That says $199 for 52 weeks is the one I got. So there you go. But just so people understand, But just
Yeah,
so people
keep
understand, so what when the Federal Reserve, so I know more about the Fed than I do about the Bank of Canada, shame on me. But I know the Federal Reserve basically pumps out these minutes. And now these people always complain that the minutes don't really reveal anything. And in a sense that they don't, but what they do enlighten investors and Fed watchers is about sort of the discussions. And so that's what I think Keith is alluding to, in the sense that you've got what is on their radar. So whether it's inflation or deflation, or if it's employment or labor markets or whatever, participation rates, they also talk about sort of they talk about the quantitative easing. They explain it in a much more thorough, sort of long-winded way. And then they also talk about, some of the board members thought that this was true. Other board members thought that that was true. It's like literally the language. It's almost like it's very, very dull reading for sure. But but I do know that there's a Bloomberg program or code or whatever that allows you to go through the words, and often, and this is how crazy people in financial markets get, they compare, like there's actually a page on Bloomberg that compares the two sheets together and then goes through all the different language. They do that for the statements as well as the minutes. And it'll be interesting to see how that evolves, because I know for a while the ECB didn't do that. And I think under Mario Draghi, they started to publish a similar type of thing where they explain what they're looking at and why. But it's always released sort of 2-3 weeks after the rate hike or what have you. Is it going to be the same thing, Keith? It's going to be released quite late?
I don't know at this point in time.
Okay.
But you remember, like for the Bank of Canada to do these two moves, okay, it means they know something is wrong. They know they have changed what they're doing. And I don't know if I read it in an article or in an interview, but they acknowledge that you like this, guys. They got the inflation call wrong. So the first step is to look in the mirror and say, yeah, you know what, we got it wrong. And in the global financial world that we're in, we're going to get a lot of wrongs. Like it is going to happen. But they're acknowledging that, and I think it's their olive leaf. Is that the right thing? Their peace offering,
olive branch.
Yeah, okay, they're trying to do that. And
but it's also about the credibility, right, Keith? I mean, it's also about the credibility, which is the bit that I think is, we've talked about. Central banks are technocrats, are not supposed to have any political bias. They're not only supposed to be independent, but they're supposed to have they're supposed to appear independent. We know that the transitory thing was a big fat lie. And we know that they bought 92% of bond issuance between, Q1 of 2020 and 2022. And that is, if that's not lack of independence, I don't know what is. So I think it's you're right. It is kind of a seminal moment that they've sort of acknowledged that they've lost credibility.
But they've also set up, so you like poor old Nicholas. If you're listening, Nicholas, here's my suggestion for you. When you're playing poker, you're at the table. If you don't know who the patsy is, it's you. Yeah. Right. Rich doesn't know that one.
I'm usually the one. You, I'm usually. Yeah, I'm aware. I'm aware it's me.
I'm really good at crazy eights, so that's my deal. Anyway, but they've now. This is not deep thinking, guys. They've now said, you know what, you guys critiqued us for doing the wrong things recently. Now we've made changes, and now they have their fall guy. So if things blow up spectacularly. They'll kick Nicholas out. He's gone. They'll delete this summary of deliberations. Vaporize it. And they'll go to something else again.
So speaking of the wrong things, we had the RBA, the Australian Central Bank, was out this week with a
Reserve Bank of Australia, sir.
RBA. That's
what did Steve call it? The Royal Bank.
Reserve Bank of Australia, the RBA. RBA. They were out this week with a very hawkish rate hike, which seemed to shock a lot of the Aussies over there. Because if you remember back in December, they effectively came out and says, we're kind of nearing the end. We're deliberating about a pause. And then, of course, they came out this week, raised 25 basis points, and said that more hikes would be needed in the months ahead. So I think perhaps a humbling to those that are, jumping up and down saying that, the inflation problem has been solved. The Bank of Canada has gone on pause. Disinflation is starting to take hold, which was Powell's comments this week. I think maybe, again, potentially a warning sign that there might still be work to be done. Maybe not today, but maybe 6, 8, 10, 12 months from now. And I think that should be the biggest concern, right? My concern personally, about the housing market here is again, that you do get, let's say, a reacceleration and you're back to, talking about rate hikes in 2024 because you've got a second wave of inflation. So, Rich, I know you were chatting about, off the air here with me, but you've got some opinions on inflation potentially coming back. And I think, Keith, I think your views might differ a little bit. So it'd be kind of interesting to sort of open up that dialogue about, your outlook on the inflation process. Rich, I'm kind of curious, where you're landing right now, because one of the conversations was, the China reopening, they've gotten rid of this COVID zero. And really what we've seen, at least in commodity prices, oil never went up during that reopening, and copper prices, while they had bounced initially, are now rolling over again. So what's your kind of take here?
Yeah, so you're front running my Substack, so I have now carte blanche to plug it, so you can read more of my thoughts on this as in the coming weeks. But I think so for me, it's threefold. One, I think oil is extremely tight, and I think that that's not going to give people the respite that they thought they were going to get. But really, it's the services component and the wage. We saw 517 new jobs for non-farm payrolls last week. Even if that number is half wrong, it still means that there's a very, very strong labor market. I've gone on record repeatedly saying that the demographics and the skill shortages are going to keep labor markets strong for a lot longer than people dare imagine or care or think about. And then that's going to push up wages, and those wages are going to keep services spending high. Remember, services is a much larger chunk of goods than goods. But the key thing, the argument, what I rounds out my whole view is the contributions. So this time last year, everybody was talking about the massive contributions from used cars and all this actually transitory stuff that was related to supply chains and COVID shenanigans and this and that. And we had massive outsized positive contributions from used cars, goods. I don't know. I can't remember now off the top of my head of all this stuff. And what you're seeing now is all of those contributions are reverting to their mean. And I think people thought they were going to revert to massively negative contributions. So from going +3 all the way to -3. But historically, that's not what the evidence shows us. We show that after you get that supply shock, you don't get a massive disinflationary force from those pieces. You just go back to normal. And so we've already seen the majority of that sort of transpire. And what that means is you're not going to get this deflationary force that people are talking about. If you look at the Manheim used car sales index, it's actually already starting to push back up on year-on-year terms. So if you say, okay, let's take away the deflationary contribution that we've got from all those sort of esoteric pieces. What's next? There's the shelter component, but let's leave that aside for a second. There's the services X shelter, and the services X shelter is a significant portion of CPI basket in Canada and the US and UK or whatever, all these developed countries. And it continues to tick higher and higher and higher. And that's because what I've said before is people are cashed up in the US. They're unlevered in the US. They have good jobs and good wages, and they're spending. And lo and behold, consumer confidence for people between the ages of 25 and 55 ticked up last month. And so it's just, I'm not sure. I haven't fully rounded out my view. Steve, you bastard, you caught me out. But I think it's important to note that the market has been rallying on this idea that inflation has been vanquished. And I can prove that to you because rate hike expectations have collapsed, and all these NASDAQ growth, Russell, Stocks 50, all this stuff has rallied on that. And what I think might happen over the next, well, I don't hope it happens because inflation's bad, but what I think might happen is you get a reacceleration, or at least a pause in that narrative about it's the end of inflation.
Keith, what are your
Keith,
thoughts?
How did I screw that up, Keith?
I got some cobwebs in my eyes from listening to that. I think we are looking at it will be transitory. That's what's happening.
No, come on. You're not allowed to use that word is banned from our airwaves now.
It's going to be like transitory will be defined like over a 5 or 10 year period, mind you. I agree with Rich and with most of what you just said. That the numbers are coming down, and right now the entire market is on the belief that we're going to have this, fairy tale soft landing. And if we get, so two things will happen here. If that is what is achieved, the inflation data is just going to take off again the second half of the year. And all of a sudden central banks are like, oh man, what do we do now? Right. It's not going to be a nice environment. And the other side is if we don't get a soft landing, it does develop into something harder. Then yeah, you're going to see it's going to be a funny inflation number that's coming out, in that it's our belief that commodity prices are soft. They're not hard. They're not increasing aggressively right now. They're coming down a little bit. But we could get into this period where the second half of this year, commodity prices start swinging higher again, but yet the economy is getting weaker and weaker. I think we're in this very difficult period. It's no longer this, you can't view it as, hey, what's the CPI number going to be? What are the central banks doing? Again, this is a very highly unusual period. We've never seen it before. Because again, just to reiterate, the policy response to COVID was to shut down the entire world's economy. And not just for a day or an afternoon. It was shut down for way too long. And then you put global conflict on top of it and nationalization, all that stuff. So I think this inflation challenge is going to be around for a while. And I don't know how they get out of it. One of the cool charts that went around Twitter today, it was Lisa Abramovich, I think her name is. She's one of the Bloomberg writers.
She's a good follow, underrated.
Yeah, she covers the bond market. Very good. Yeah, she's really good. And so she's made a comment that the inverted yield curve, so the 10 minus the 2, is now at the most negative point since the early 80s. So it's a great chart to see that. And so if you think about it, like it's over 40 years now. This is the most inverted the yield curve has been. And people are saying, hey, there's going to be a soft landing. They have the reasons for it, because of, central bank actions on the balance sheets and things like that. But it's something is happening. Something is going to come down. And if this is a soft landing, that's awesome. But it's looking more likely that, maybe Credit Suisse guys are right. Maybe they have to claw back a bit. So I'm
Keith, what do you
the economy.
What do you think of so given that you just said that, what do you think about this new stuff thing? There's no landing, that we're just going to take off from here, and it's in it's like we're going to re-accelerate. It's a new paradigm.
The new paradigm. Yeah.
Of no landing.
Yeah, that's a good point of no landing. You just, because you can't sit still, right? You think about an airplane, right? You can't get stall speed, right? You're either going to, come down hard, or you have to re-accelerate. If we re-accelerate, the central banks will raise rates again. I mean, that it's going to happen. And Steve's going to be tested at like 18%, 22% and all that stuff. And if that happens, it's just going to create, these crazy opportunities in the market.
Go ahead, Keith. Sorry to interrupt you.
Yeah, like I was chatting with a guy a couple of years back, and he was a bond trader back in the early 80s. And he was telling me, they were on a dealer desk. So Ford just issued this bond, this debt issuance. And I think it was yielding, he said like 18% or something like that. And he said, Keith, we could not give this thing away. Nobody would touch this with a 10-foot pole. But yet if they did buy it, it would have been one of the best investments they ever bought in their life, right? Because it was, that is at the bottom of the bond market, or the height of the yield curve. You think about it, maybe we are going to go back to something like that, this extreme swing in one of the markets. But again, I keep going back. I keep sharing with everyone that, risk has been synchronized around the world. And this is one of those points, something might go a bit offside here right now. But check out that yield curve, the 10-2. It's on my Twitter feed. I sent it out. I think Steve might have it as well. But it's
we'll include it in our Substack, in the Loonie Hour Substack. I'll make
go
sure
subscribe
to include it there.
But I think one of the things to highlight here as well is in the land of the dead, aka where there's been no inflation for almost 2 decades. Japan reported the biggest jump in nominal wage growth. Last quarter there, over 5%, wasn't it?
I can double check for you. It was very high.
But Rich, to your point earlier, right, which is, maybe you have structural inflation in the jobs market, and that just becomes a challenge. I mean, obviously, central bankers keep saying we need to weaken the labor market. And they're certainly trying, but there's this mismatch, and wages are sticky.
Well, there's another angle that I'm not going to include in my aforementioned note, but just productivity. And when you pay people to stay home to do nothing, well, let me inform everybody who's paying attention that that's not good for productivity growth. And this idea that people are working from home and they're just as productive or more productive than being in the office. And I know this is going to result in a crap load of comments to the contrary, but I would submit to you, if you look at labor productivity growth basically around the world, it's collapsed. Well, maybe not everywhere, but it's definitely low. And I think that that's the other angle on this side, which is if you have weak productivity growth, that's an inflationary kind of impulse. If you have excellent productivity growth, that is a disinflationary impulse. And I think that's something we don't really talk about. I mean, I think I saw something that only 50% of workers are back in the office in the United States. I haven't seen the numbers for Canada, but I imagine it's the same thing. And I think that's just something. I mean, I can't touch that. It's way too broad and difficult a subject to sort of nail down into, 700, 800 words. But it's just something we haven't really discussed here, or I don't think is talked about enough.
You mean universal basic income combined with MMT is a bad idea?
Yes, MMT is bullshit.
Well,
maybe the three of us should move in to Steve's flat, and then we'll start doing the Loonie. 3 of us sitting down together doing the Loonie Hour.
I mean, no one wants to say that, right? But paying people to stay home, that's not good That's not good for productivity. I'm just... It's amazing. I look at a lot of the central banks. They do great research, to be honest. A lot of these central bankers, they're really, really smart people who they don't let anywhere near the policy levers, of course. They keep them in a basement somewhere where they're not allowed to talk to or look at anybody. But they do an excellent amount of research on trade flows and R star and productivity growth and wages or environmental vehicles and their impact on the grid. Or they have loads of brilliant people who do all this research. And it's just something normally I'm surprised there hasn't been anywhere near enough. I mean, maybe I've missed it. If I have, please send me those papers. But they usually do lots and lots of papers on these kinds of things. What happens when you shift an economy in a certain way? How does it affect your equilibrium growth rate or your potential growth? And I'm surprised there hasn't been as much work on that as I think there should be.
Big papers guy here. I think that's a good place to.
We make fun of central bankers a lot, and they deserve a lot of criticism. But what we often don't acknowledge is a lot of the data that we rely on comes from central banks. A lot of statistics that we rely on and look at comes from central banks, and a lot of these underlings, these people will never ever hear about. Whether they're the people who invented the 3 preferred measures of core inflation that Tiff Macklin insisted on ignoring.
What fun would it be though in a world where you couldn't dunk on the central banker?
Yeah, that's true. But what I mean is there's a lot of really smart, hardworking people who work for these organizations and that are then ignored by the policymakers. But it's just we got to acknowledge them every once in a while.
Rich is a part of the swamp. Drain the swamp. All right, that's a good place to wrap it up. Keith, you have any parting words? Any parting words of wisdom?
No, it was a good one today. Looking forward to more rich stories next week.
More papers. All right. Well, as always, guys, we appreciate the support. Please leave us ideally leave us a 5-star review there on Spotify, Apple Podcasts. Help us continue to grow the Loonie Hour community. We appreciate your support, and we'll see you next week.